Hey, what's up everybody? Today we're going to tackle one of the harder concepts to wrap your mind around. It's not really a complex topic, but I think that the reason why it's so hard is simply because of these terms that we use have other definitions that we're more used to. So by the time you start to learn accounting, you already have a definition for debit and credit. And it doesn't agree with the accounting definition of debit and credit. And so that really messes people up. So we're going to try to do this in a very simple way. First of all, completely throw away every definition that you have for the term debit and credit, okay? We're not talking about debit cards, which reduce your cash balance in your checking account. We're not talking about debiting an account that will create, a decrease in any kind of account. We're not talking about a credit card or charging things on credit where you owe someone else money. We're not talking about crediting something to your account where it increases your account. So whereas your mind typically thinks debit means decrease and credit means increase, you need to completely throw that away, because sometimes a debit will increase, sometimes it will decrease a particular account. A credit will sometimes increase or sometimes decrease a particular account in accounting. They have nothing to do with that. We could have named these something completely different. We could have named them John and Bob, okay? We could have named them left and right. We could have named them up and down. They could have had any other name, and potentially that would have been more helpful for you to understand it, because again, of just in your mind, you have this debit and credit either means decrease or increase, and that's not the case in accounting. So what we're going to do is we're going to color code everything here. So the color code here is going to be debits are blue and credits are green. So as I just mentioned, we could have used blue and green when we named these elements to accounting way back when accounting was invented. So the basics of double entry accounting say that anytime there's an entry, there has to be a second balancing offsetting entry. And those two things have to agree with one another or equal one another. So if you spend money out of the checking account, say you spend $100 out of your checking account, then that $100 has to have an offsetting entry of $100 somewhere. So if I decrease my checking account by $100, I have to do something else. I either have to increase an expense by $100, or I have to decrease a liability by $100 because I paid it down, or I have to increase another asset account by $100 because I spent that money. So you'll see how that makes sense, right? $100 came out of the checking account. We have to balance that with $100 somewhere else. Now that can be split up in in multiple. So double entry doesn't just mean two, because it just means that those two sides of the transaction have to equal. So if I decrease checking by $100, but that check went towards two different things, I can break that $100 up into 80 and 20 as long as those two things still add up to the 100 and offset. So let's jump into a real quick example and help show how this works, all right? So again, debit is blue, credit is green. And we're going to jump into kind of the color coding up here and how each account has kind of a normal or standard balance that's a debit or a credit. But that'll come into play in a moment. So anytime that something happens in accounting, there's a journal entry that is created, or an accounting entry that is created. That's the two-sided entry that has to agree with one another. It also gets into why when you look in your accounting intro to accounting book, the definition of a debit is left side of the transaction, and credit is right side of the transaction. That doesn't do you any good to read that. Trust me, I know, because when I took my intro to accounting and I read that definition, I said, that doesn't help me at all. But it'll make sense once it clicks. Once it clicks, and you just have to reinvent these definitions for accounting in your mind. So if you are to spend $100 out of your checking account, you're going to credit checking $100, okay? And let's say we spent that $100 on advertising. Then we are going to debit advertising $100, all right? So this is where left and right comes into play. So a credit is right-hand side of the transaction. That's why I made the $100 kind of over to the right. And a debit is the left-hand side of the transaction. That's why I made the $100 here over to the left. So debits are on the left, credits are on the right. Now, if you look, crediting the checking account, I told you we spent $100. So you can just think in your mind, okay, if we credit the checking account $100 because we spent that money, that's actually decreasing the amount of money we have in the checking account. And by debiting advertising by 100, that's actually increasing the amount of money that we spent in this particular expense category. So you can see how our typical definitions for debit and credit have already been completely thrown out the window. So that just bear with me right now. I know it doesn't make any sense, but you credit the checking account to reduce it. You debit the advertising expense account to increase it. Now, again, double entry accounting, they kind of have this left and right hand side of the transaction, and whatever happens on this side has to equal what happens on this side. So kind of the same thing I just mentioned. We could write a $100 check, and it could be for advertising, but also for materials. So if we spent $80 on advertising, then we must have spent $20 on materials, because again, 80 and 20 is 100. This left-hand side or debit side equals 100, and we spent $100 out of the checking account, so this right-hand side or credit amount equals 100. So debits always have to equal credits. Left side always has to equal the right side, even if it's broken down into multiple parts of the transaction. All right, so let's look at, that's just a typical journal entry. Let's now look at how that interacts with our balance sheet and our income statement. Now I have another video, I'll post a link here. It talks a little bit about the interaction between and a introduction to the balance sheet and the income statement, but we're going to cover a little bit of that here as well. So let's take this same journal entry and let's put it on our balance sheet and our income statement. So first of all, let's cover things that have a typical balance. So everything has a balance sitting there, right? So you might have money in the checking account, you might have some equipment that you own, you might have a loan, you have equity. Each of these are going to have a balance. So you have a chart of accounts, and those accounts have maybe a balance sitting in them, same as your revenue, expenses, and net income. So they each have their own typical balance. So assets have debit balances. So that means that if you have an asset and it's positive, you have money in your checking account, it should have a debit balance. If you have a loan and you owe someone money, it should have a credit balance. If you have equity in your company, it should have a credit balance. At the same time, if you have revenue and you've made money, there should be a credit balance and a revenue chart of account. If you've spent money and you have positive expenses where you've spent money, they should have a debit balance sitting in that account. And net income should be, if it's income, a credit balance as well. So let's walk through this particular transaction. First, let's say you opened your company by spending $1,000. Not spending, sorry. Let's say you opened your company by depositing $1,000 into the checking account. So you put $1,000 into your checking account. That was a debit of $1,000 to increase your cash account. You would credit your equity $1,000 because that's your equity in the company. So debits, blue, equal credits, green. In this particular case, that journal entry is balanced. Blue equals green, debits equals credits. All right. If we were to look at it here, we would have had checking in blue of 1,000, equity in green of 1,000, with both sides of the transaction balanced again. So that is how you opened up your business. Now let's do this transaction where we spend $100 on advertising. So the journal entry itself, we're going to credit cash $100, and we're going to debit advertising $100. Okay, so our debits and credits, our blues and our greens equal. 100 equals 100. All right, this reduced cash, as you can see, because they're different amount, they're different colors, blue and green netted together would be a blue balance of $900. All right. Blue by itself is going to be a blue balance of $100. So again, this is the transaction, and then this is our running total. Okay, I don't have enough room to show this in any other way, but just know that's the transaction, and then our running balance is here. So 1,000 minus the 100 is 900, and 100 with nothing else there is 100. So our revenues of nothing minus our expenses give us actually $100 loss, or $100 of blue. debit balance. So revenues minus of nothing minus expenses of 100 equals net income, or net loss in this case, of 100. That 100 actually flows through to the equity section. So we still have our original $1,000 of equity, and now we have $100 of loss coming from the income statement, which leaves our net equity amount as a $900 green or credit balance, okay? Because these two are being netted together. 1,000 minus the 100 is 900. So our 900 equals 0 plus 900. Blue equals green. Debits equal credits on our balance sheet. Income statement doesn't have that same kind of thing where debits equal credits, because it's interacting here and flowing through. So we have no credits because we have no revenue. We have a debit in our advertising expense, and we have a debit balance overall of $100, which is a net loss. That's going to flow through and help our balance sheet balance, because that at the end of the year is going to be closed out to your equity accounts, and that's how it's going to work there. Now, let's say we buy a piece of equipment. Okay, so if we buy a piece of equipment, we're going to debit cash, which is going to decrease cash, $300. Okay, so this transaction needs an offsetting $300. It's got a credit of $300. It needs a debit to offset it. So we're going to debit equipment by $300. So we bought a computer, we bought some sort of piece of equipment that needed to be capitalized and put on the balance sheet. So we credit our cash, $300, which is going to reduce it. We're going to debit another asset, which assets have debit balances, so that increases that account. And we're going to end up here, if we net the 9 and the 3, we're still going to end up with an overall blue balance. 9 minus 3 is going to be an overall blue or debit balance of 600. 300 plus nothing is going to be 300. Our assets are now 600 plus 300 is 900, equals liabilities of nothing plus 900 of equity. So 900 equals 900. Balance sheet is still balanced, okay? Those are a couple of examples, and hopefully the color coding helps this a little bit. But as you can see, debits and credits, you just need to throw it out completely and just remind yourself, okay? Assets have a debit balance. In order to increase an asset, I have to debit it. Liabilities and equity should have a credit balance. In order to decrease those, in order to increase those, I need to credit them. Revenues should have a credit balance. In order to increase them, I need to do a credit. Now let's walk through that as well. Someone pays you $1,000. Okay, so if they pay you $1,000, you need to increase cash. Cash has a debit balance, so we need to increase it with a debit, or blue, of $1,000. Well, again, because we have to keep this balanced, if we debit something, we have to credit something. Someone paid you $1,000, you debited cash $1,000, you're going to credit revenue $1,000, okay? So blue and green equal, debits and credits equal, there's our $1,000. So this increased our revenue to $1,000. This increased our cash, 600 plus 1,000 is now 1,600. That's our balance in cash, 1,600. Our balance here is still 300. Our equity that we started with is still 1,000, but our income statement changed, so we got to get the other piece of the equity from the income statement. We have 1,000 now of revenue minus our same 100 that we had earlier in expenses is going to equal $900. So again, credit, that's going to be net income of 900. So the 900 comes through to the balance sheet as part of equity. All right, so now we have 1,600 plus 300 is 1,900 of assets equals no liabilities plus 1,900 of equity. So 1,900 equals 1,900. The balance sheet is still balanced. Each individual transaction is still balanced and agreeing as well. So again, the point here is debits and credits, blue or green, doesn't matter how you define them. they have to equal each other. Blue always has to equal green. Debits always have to equal credits in each individual transaction. And then when we look at the balance sheet as a whole, assets always have to equal liabilities plus equity. Assets have a debit balance when they have a positive balance. Liabilities have and equity have a credit balance when they are positive or in good shape. Revenue, and then by default net income, would have credit balances when they are positive, and expenses would have a debit balance when they actually have a positive balance in them. So again, the whole point of that is it's just how it works. Because if we were to reverse everything, you honestly could have, and don't let this get confusing, maybe just skip past this part if you think it's going to confuse you, but you could have flipped everything. Assets could have had a credit balance if revenues have a debit balance and expenses have a credit balance. Assets could have had credit balances if liabilities and equity have debit balances. If we flipped everything, it would still work, because then we would credit cash $1,000. We would have to debit. If credits were increasing cash, we would debit revenue. Debits and credits would equal. That would increase, that would increase. So again, just kind of ignore that part if that's going to be really confusing, because the whole point of that is it could be flipped. It doesn't really matter. It's arbitrary which way it goes. You just have to learn the way that it actually is. So again, what helped me with this, you just commit it to memory, because the actual definitions, there are no actual definitions. Again, if you look in your glossary to your intro to accounting, debit is going to say left-hand side of the transaction, because that's the side that someone decided to say was the debit side. And credits are going to say right-hand side of the transaction, because that's what someone determined would be on the right-hand side. And the whole reason why they have left hand and right hand is just to make sure that both sides equal each other, to make sure everything is accounted for. So again, debits and credits, arbitrary, just commit it to memory. Assets, debit balances. Credits and liability, credit balances. Revenue, credit balances. Expenses, debit balances. And then net income would hopefully be a net credit balance, because revenue being larger than expenses would result in a net credit balance there of income. All right. Now, there are ways to show debits and credits as positive and negative numbers. I think that at this point, we're going to go ahead and cap this video at, whatever the time is here. It's been a little bit long, definitely shorter than an intro to accounting class. So if you're watching this, hopefully it's not as much time as you would spend learning this in a class, but I'll go ahead and cap it. Don't really want to jump into that negative and positive piece of it, because that just gets a little bit more confusing. But for now, the main thing to know is just commit this to memory. What has a debit or a credit balance? What is going to be increased or decreased by a debit or a credit? What goes on which side of the transaction, debits or credits? And this will actually help you as you look through your general ledger. Because real quick, as you're looking through a general ledger in QuickBooks, okay, you want to have the debit and the credit column as well as a balance column. So if you're looking through your checking account, you're going to have debits and credits, okay? There's going to be debits on the left, credits on the right, and you're going to see both of those things marking transactions where money went in and out of the checking account. But when you get to the income statement and you start scrolling through the general ledger, this is one of the easiest ways that, I just know how to catch things in general ledger, is because when you're scrolling through the general ledger, your revenue is mostly going to all be credit or on that right-hand column. So you can quickly scroll down, and if something pops up in the left-hand column of debit, you're going to say, whoa, what's that? Why is there a debit in a revenue account? And you can see that real quick. Now, it might have been a refund, in which case you were reducing revenue and a debit was correct. But if you're scrolling through the expense accounts, everything should pretty much be a debit. It should all be on the left-hand side of that debit and credit column, because expenses should have debit amounts hitting them. So what you'll see is someone will spend money out of the checking account and they'll accidentally post it to equity when it should have been posted to expense. Or they'll report a deposit into their checking account, and instead of it going into revenue, they'll accidentally post it to an expense account. So when you're looking at that two column, debit and credit, it's very easy to spot something that's out of place on the income statement because of that particular way that accounting works. So there it is. Hopefully it didn't confuse you even more. Maybe the colors helped a little bit. Feel free to put comments in the comment section and ask me to explain a particular thing, or if this didn't work, maybe I can think through another way of trying to help you understand the debits and credits in accounting. My name is Brad. I'm with Wooten CPA. My goal is to bring peace to your finance and tax responsibilities. Please subscribe to the channel. Don't forget to hit the like button on this video as well as the bell so you're notified when new videos come out. Thank you for watching.